Everybody, let's get started. We're gonna keep this short today. Tesla stock is up, I think 2%. Yep, 1.8%. Everything else is pretty much down. Dow Jones down 0.7%, Nasdaq down 0.8, S&P 500 down 0.9, Russell 2000 down 1.1%. Let me know how the sound quality is, please, if you can. Whether you're on X on YouTube, I would appreciate that. And I'm going to post the YouTube views, the YouTube link as well here in the comments. Give me 1 second. All right, here it is. You can watch on YouTube through the link at the top of your screens. All right. Sound quality on YouTube sounds good. All right, perfect. I'm looking at the map. Chip stocks are down substantially. Micron is down 9%, and I think it's pulling down the entire chip sector. We're going to take a look at that. And then let's see where else do we see some change. Consumer cyclicals, lodging, Marriott down 5%. I've been talking about the downtrend in hotels in recent couple months here. Hotels and travel and flights are down substantially. Hilton also down 3-4%. Not sure what's going on there. We can take a look at that too. Lockheed down 6%. Boeing up 4%. Okay. UPS is down 3. FedEx was down about 10% this morning after some anemic results and guidance revision. And that's a big deal because they are a bellwether of transportation across the world. So this is in line with my recession prediction. And so is Nike, down again very substantially. Nike is down about 70% from its all-time highs. So I wrote an article about a year ago, said to wait for lower prices on Nike, published that on Seeking Alpha. I'm going to do a follow-up on that and see where the stock stands today and a potential long position. Nike is down 6% today. Costco, Walmart flat. Coca-Cola down 2%. Basic material stocks are off about 2-3% as well. Steel is down. Steel Dynamics down 4%. New car is down about 8%. Yeah. So everything is pretty much down today, except for Tesla, up about 1.7. It's a dead cat bounce, basically. I think the I don't see how the stock can stay above $100 per share. Despite the all hands meeting from last night from Elon making promises left and right, which obviously the his lawyers will disclaim as corporate puffery later on when he gets sued for it. And it's kind of he's taking advantage of this technical legal technicality, and I'll pin this at the top of our screens as well if you haven't seen it. Assertions or corporate optimism or statements or mere puffing are not actual material misrepresentation under federal security laws because no reasonable investor would rely on such statements according to Elon's lawyers. And because he's been acquitted and he's been kind of taking advantage of this, and he now knows for sure that this defense works, he's just taking advantage of it left and right. So I would just ignore anything he says. I don't think it has any bearing. Any bearing on the market or the stock at this point, except for retail investors who are just new to the stock. Let's take a quick look at what's going on in the markets. Wall Street falls on tariff woes. FedEx slides after bleak forecast. Let's read this article. Wall Street's main indices declined on Friday as investors continue to navigate the complex landscape of tariffs, with FedEx becoming the latest firm to adjust its annual projections due to the economic uncertainties. FedEx fell 11%, while peer UPS lost 3.3%. Delivery firms are often seen as a barometer of the global economy given their involvement in a wide range of industries. The delivery companies weighed on the Dow Jones Transport Index, which is often seen as a gauge of US economic health. The index fell 2% and has lost over 19% from its November all time peak. Airlines such as Delta and United also dragged the index lower. After Britain's Heathrow Airport was shut, sparking global travel turmoil. In an interview, Chicago Fed President Austin Goolsbee noted that the current condition could maybe a shock to the economy. Separately, the New York Fed President John Williams reiterated the central bank's monetary policy stance given the uncertainty. Lingering fears of a prolonged global trade war threatening to unravel economic stability and squeeze corporate profits have cast a shadow over markets. Markets now await President Trump's plans on reciprocal and sectoral tariffs that are expected to take effect in early April. Quote, we really don't know what the wild card is coming out of Washington, and this goes for the Fed as well, head trader at US Global Investors said. Friday's session also marks the simultaneous expiry of quarterly derivatives contracts tied to stocks, index options, and futures, also known as triple witching, which added to market volatility. On a weekly scale, the benchmark S&P 500 index is on track to mark its fifth straight week in red, its longest weekly losing streak since May 2022. The tech-heavy Nasdaq is on track to record its longest weekly losing streak in nearly 3 years, while its blue chip Dow is positioned for marginal gains. Really, even with Nike and FedEx? Okay, we'll take a let's take a look at that real quick. Dow. So we have no, FedEx is not part of the Dow. I didn't know that. Nike is, and it's pulling down Dow. Um, what's up this week? Boeing is up 4%. Interesting. There was a big jump earlier in the week on Dow. Friday, Thursday, Wednesday, Tuesday, Monday. Monday, big jump. Anyway, I'll look at that later. Okay, let's continue. Earlier in the week, investors took some comfort from comments Fed Chair Jerome Powell, who said that the overall economy was on solid footing, but warned of a cloudy outlook on the impact from Trump policies. Traders are pricing approximately 70 basis points of rate cuts from the Fed this year, according to data compiled by LSEG. Nike slid 8% after the sports apparel maker projected a sharper decline in fourth quarter revenue than analysts had anticipated. Micron fell 7% as the chip maker forecast third quarter gross margin below estimates. Yeah. So this gross margin hit is also the reason why Nvidia dropped quite a bit after they announced earnings. And now we're seeing Micron. And I think it's a overall sector and also overall economy issue as well. Lennar slid 7% after the home builder reported a lower first quarter profit, which was also due to gross margin miss. Declining issues outnumbered advances by 4-to-1 ratio on NYC and 3-to-1 on NASDAQ. Okay. Let's see what else here. Let's take a look at FedEx. But this week, Tesla and Nvidia down 4%, Meta is down 3%. Um, Chip stocks are down generally speaking. Financials are up, so maybe that's why Dow Jones is a little higher than others. Financials are generally up. Um, and then what else is up? Walmart is kind of flat. UNH is up, United Healthcare. That's probably why. Okay, let's look at FedEx. It's the second quarter in a row. FedEx is disappointing pretty badly. Last time this happened, the stock dropped from over $300 per share to $250 per share. So that was a massive drop. But then in the following 2 months, um, so this was September. Following 2 months, the stock recovered to above $300 per share again. Since then, it's been a downward trend. And last quarter, it dropped from 290 to 250, and then retraced back again, and then continues drop. So I wonder if it's going to retrace again this time. I guess we'll find out in the coming days. Let's look at some of the details here. Oh, I know what I want. Give me 1 second. Okay. FedEx targets $2.2 billion drive savings for FY 2025 amid strategic network transformation. Okay. We're going to get to that. FedEx isn't the stock to own when things go south, says analyst. Okay. These results were announced last night. Let's discuss some of the details here. They missed non-GAAP EPS by 12 cents, by about 2%, 2 to 3%. Revenue was up 2% year over year. FedEx completed its $2.5 billion fiscal 2025 share repurchase plan with $500 million in share repurchase via open market transactions during the quarter. Approximately 1.8 million shares were repurchased, with the decrease in outstanding shares benefiting third quarter results by 12 cents per diluted share. As of February 28th, $2.6 billion remained available for repurchase under the company's 2024 stock repurchase authorization. Cash on hand was $5 billion. Revising its fiscal 2025 earnings and capital spending forecasts, and now expects revenue flat to slightly down year over year compared to the prior forecast of approximately flat. Diluted EPS of $15.15 to $15.75 before the MTM retirement plans accounting adjustment compared to prior forecast of 16.45 to 17.45. So at the midpoint, that would be about 17 to 15 and a half, 1.5. So there's almost a 10% drop in diluted EPS forecast. That's massive. And 18 to 1860 per share versus consensus of 1918. So that's 6-7% drop from consensus, excluding costs related to business optimization initiatives, etc. Okay. Prior forecasts were 19 to 20. Yeah, that's massive. They really revised down their forecast. That's wild. Capital spending of $4.9 billion compared to the prior forecast of 5.2, with the prior of investments in network optimization efficiency improvements. Okay, so they pull back on capex. Okay, I mean this kind of spells the recession, but reaffirming its forecast of permanent cost reductions and ETR. I don't know what that means. Okay, let's look at the next one. FedEx lowers guidance on continued economic weakness. Let's get some color from the call. To compensate for the continued weakness and uncertainty in the U.S. industrial economy, FedEx again cut its fiscal year 2020. So this is the second cut that were below Wall Street's already lowered expectations and sending shares another 4% late trading. Citing the challenging economic environment that has constrained demand for its business-to-business services, FedEx now expects revenue to be flat to slightly down year over year versus prior forecast approximately flat. We went through these details. By segment, operating results improved at Federal Express, but were down at FedEx Freight due to lower fuel surcharges. Okay. Reduced weight per shipment and fewer shipments. So across the board is pretty bad for FedEx Freight. Partially offset by higher base yield. Putting everything together, the results for the third quarter disappointed. The guidance is not a positive one, and all the layers on top of trade uncertainty that could further compress the business. Okay. Revenue from FedEx Freight has been declining pretty much every quarter for the last 3 years. Interesting. Revenue from FedEx Express has been volatile but flat versus 3 years ago. Okay. CEO outlined key achievements and challenges, reporting 2% revenue growth year over year, achieving $600 million in cost savings, blah, blah, blah. CFO said drive savings, they focus on drive savings. Okay. Outlook, we talked about that. Company anticipates sequential growth in drive savings. No one cares about savings. Adjusted operating income increased 12% year over year, supported by $600 million in savings. Freight revenues declined 5% due to lower volumes and softer industrial economic conditions. Evercore analysts asked the impact of inflation on operational costs and margins. CFO explained that inflation remains a consistent challenge, particularly in areas like wages and peak season costs, which the company aims to manage through structural cost controls. Deutsche Bank analysts inquired about exposure to potential changes in the de minimis tax rules. EVP Bree assured that the company is operationally prepared and working closely with customers to navigate potential regulatory changes. Wolf Research asked about fiscal year 2026 outlook and the progression of key initiatives. CFO indicated that macro pressures are expected to persist in the first half of fiscal year 2026, but incremental benefits from drive and network initiatives will support long-term profitability. Okay. For the next several quarters, basically, FedEx is saying it's going to get worse. Sentiment analysts exhibited a neutral to slightly negative tone, reflecting concerns about guidance, reduction of economic uncertainty. Management maintained a confident tone in prepared remarks, emphasizing progress in cost savings and network transformations. Responses were more cautious, reflecting an uncertain demand environment. Prolonged weakness in the industrial economy continues to pressure B2B volumes, particularly in higher margin freight and priority services. Inflation and cost pressures, especially in wages and transportation, pose ongoing challenges to margin expansion. Yeah, I mean, this is the story for a lot of companies, actually. So I'm going to take some notes down. Um, 321. FedEx and Nike and Lennar all down 10% on misses and guidance revisions. Okay. We're gonna continue other stocks too. Let's see. FedEx Corporation reported modest revenue growth, significant progress on blah 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 blah. Okay, I think we covered FedEx one. Let's go next to Nike. I mean, it's crazy. The people. I think the fact that people are buying the dip is nuts. This is just getting worse. Nike. CEO emphasized progress on strategic actions aimed at reposition Nike's business and brand. He highlighted win now priorities, focusing on five fields of play: running, basketball, football, training, etc. Key countries: US, China, United Kingdom, and influential cities: New York, Los Angeles, London, Beijing, Shanghai. Any questions on YouTube? Please leave it in the comments. Give me 1 second. Okay. He'll acknowledge challenges in classic footwear franchise performance, but stress efforts to diversify the product portfolio with new innovations such as Pegasus, blah, 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 Air Max, the early positive consumer response. CFO reported that Q3 revenues declined 9% on reported. I mean, that is massive. Like, what is a company that is declining 9% on a revenue and gross margin decreasing 330 base points doing with a P ratio of 22? Yeah, this stock I don't think is has bottomed yet. That's a massive drop. 9% revenue drop. Management forecasted Q4 revenues to decline in the mid-teens range and gross margin expected to decrease by 400 to 500 basis points. So Q4 is going to be worse. Factors contributing to this outlook include inventory liquidations, restructuring charges, and foreign exchange headwinds. Massive. How in the world would you pay 22 times for a company that sees revenues decline in mid-teens year over year? Longer term, the company plans to accelerate product portfolio shifts, manage excess confidence. Okay. Gross margin contracted to 41.5%, reflecting high promotional activity and inventory-related adjustments. Inventory levels decreased by 2% year over year, but remain elevated across all geographies. Question the timeline for cleaning up classic shoes inventories. Bank of America listed. CEO and CFO explained efforts to right-size the inventory mix with both direct and wholesale channels, with significant progress expected by fiscal 2026. I mean, we're going to a deflationary period, I think. But Nike is a global company. Let me just see what percent of Nike's revenues are generated in the US. What percent? Um, 43% of total revenues. I mean, that's actually higher than I expected. And this is North American revenue, so it's US, Canada, etc. Canada is usually 1/10 of US, so let's say 40% is US, and then you obviously have Mexico in there too. So maybe 1/3 in US, a little bit in Canada, a little bit in Mexico, and the majority is outside of North America. So it's a global. I mean, it's a global company. So this doesn't bode well. Both FedEx and Nike does not results and guidance don't bode well for a global economy. Goldman Sachs inquired about innovation pipeline. CEO expressed confidence in upcoming products. Blah blah blah. Bernstein asked about timeline for new performance products. Okay. Analysts raised concerns about pace of inventory cleanup and the impact of promotional activities on margins. The tone was slightly negative, reflecting skepticism about near-term challenges. Management maintained a confident tone during the prepared remarks. During Q&A, response to inventory and revenue-related questions indicating acknowledge ongoing challenges and the need for sustained efforts. Continued revenue and gross margin declines reflect the ongoing challenges. Um, Elevated inventory levels and reliance on markdowns remain key challenges, with potential impacts on margin and brand perception. Geopolitical uncertainties, foreign exchange volatility, competitive pressures in markets like China pose additional risks. Management outlined mitigation strategies, including tighter buying practices, liquidation through value channels, and investments in brand marketing. Nike is taking decisive actions to address inventory imbalances and reposition its product portfolio toward performance-driven innovation. While near-term financial results reflect the pressures of these adjustments, management is focused on building a foundation for long-term growth through strategic investments in brand visibility, product innovation, marketplace alignment. Too soon to get into. I think what's the space? Bill Ackman is kind of caught in this stuck apparently underwater pretty badly. Should have read my article from 1 year ago. I said, wait, don't buy yet. And then the other stock I want to look into is Lennar. And then we're gonna do some accounting stuff on Tesla. Let me just bring up Steven, and then we're gonna go into some accounting topics. Um, wow, this is a very undercovered stock here. Lennar is a pretty big company. Surprising. I think it's one of the top two or top three, and probably top two, and maybe number two, actually, home builder in the nation. Right, let me see if I can find a different source. Lennar stock sinks as home builder warns a weak housing market. Huh, CNBC headline. Last night was Lennar shares jump on Q1 beat. Nope, that reversed. Let's read this article. Shares of Lennar are tumbling 7% in intraday trading Friday as home builders warning of a weak housing market offset better than estimated quarterly results. Co-CEO said a challenging macroeconomic environment for home building weighed on the company in its fiscal first quarter, while demand remains strong. Persistently higher interest rates and inflation, combined with a downturn in consumer confidence and a limited supply of affordable homes, made it increasingly difficult for consumers to access home ownership. I shorted home builders a few months ago and then closed it for a 50% return, but maybe I closed it too early. Miller said the company delivered 17,800 homes during the first fiscal quarter and recorded new orders of 18,355, but reflecting continued weakness in the market. Average sales price after incentives fell 1% year over year to 408,000. He said, interesting. That's very interesting. So the average sales price after incentives fell in housing. I don't think this happened in a long time. So that's ChatGPT. When was the last time housing prices, home price in the US fell year over year? Early 2023, and then before that was 2012. The most recent year of a decline in home price occurred in the period of the Great Recession, which lasted from 2000 to 2009. So what's this year over year, early 2023 in response to? Decline was modest, about negative 0.2%. Like that doesn't count. Price has been rising there. Um, in the recent years, certain metropolitans have experienced a repair, but the national has generally continued to rise. Yeah. Okay. Let's continue with the Lennar article, and then if Stephen can come up, we can dig into these accounting concerns from Tesla. Miller said, in general, net prices for homes as well as rents in overbuilt apartment markets have begun to drop as demand remains constrained by affordability. Lennar posted fiscal first quarter earnings of 1.96 on revenue of 7.63 billion, ahead of estimates. But it's not very well covered, so it doesn't matter. For the second quarter, Lennar projected new orders between 22,500 and 23,500, with an average sales price in the range of 390,000 to 400,000. Shares are down 30% in the last 12 months. Um, wow. So it's a quarter over quarter drop in sales too. Take the midpoint, 395. You're looking at 8, 13, 3% drop. That's really weird. Then our stock is down 4%. That's recovered a little bit. But generally down. These are lowest since late 2023. I mean, these stocks were getting really, really expensive. So it's kind of expected. But if they get cheap, I'll probably buy some one of the home builders. Let's go to um let's go to these accounting issues. Let me see if there's any comments, questions on YouTube, etc. Let's do a market check. Tesla stock is up 4%. Overall markets are down. That but slightly down. They're kind of recovering a little bit. Nike, FedEx down quite a bit. Lennar is down also. Micron is also, and that's the other stock I want to look into. I think it was margin concerns we mentioned. All right. The other thing I noticed is the resale values of Model Y are plunging really fast, as well as Cybertruck. So, to the extent that this stock volatility up and down every now and then, I think next week Tesla stock is going to plunge pretty badly. You can now get a Model S for a couple $1,000s these days. I'm just looking at one for $5,000, an early Model S, 2014 actually. So you can get many Teslas below $10,000 today. Model 3 price are also below 10,000. These are just like 4 or 5 year old Model 3s. And Model Y prices are below $20,000 now. So that's even before the Model Y production ramps, the new Model Y production. So right now, Tesla is only selling the $60,000 launch series edition in the US. but the orders of the long range one and the real wheel or the standard range one has opened up in China and many other countries as well. And it's going to happen in US as well next week, maybe in 10 days or so. And when that happens, you're going to see the used Model Y prices really accelerate downward. And then after that, I expect Tesla to have to do a 0% APR, 0 or 1% APR for the new Model Y by the end of this year, combined with $40,000 prices. So, I mean, the direction of these vehicles' resale values is, pretty apparent at this point. All right, let's go to these accounting issues. I'm gonna go to what's his face? Gordon Johnson. I think he posted a thread with a bunch of them, and we can kind of go through one by one for about half hour or so, and then we'll call it a day. Christina, how are you? Christina, you have to unmute yourself. Let's see if we can bring her up. Looks like a connection issue. I'll send her an invite to speak. Maybe that works better. All right. Where is this thread? If anyone has the thread of these accounting allegations, please leave it um in a reply to the space. It's having difficulty finding it. Let me see if somebody posted it. Can't find it. But I find this thread by Gordon that says, "I told you years ago, Tesla, that A would be taken out by the Chinese competition," which he did tell us, and I ignored, and he was right. B, Tesla FSD is fake and would never work barring LiDAR and radar, which turned out to be true. I doubted it, and he was right. Tesla's margins would implode. He was also right on that. And EVs were not the future of cars. And he's been right on that too. Yeah, amazing. Gordon asks, what exactly is it I've been wrong about Tesla? Happy to come on the show and discuss. Or are you guys against having people on this? Blah, blah, blah. Did you take a. He went back and forth with Joe. Interesting. Steven, how are you?
Good, Yaman. How are you?
Good. Do you know where this thread is for the accounting allegations? I can't find it.
I thought Political Reality did a piece, but I could be wrong. I don't have a source yet, sir. That's over my head.
I thought Gordon posted it. I can't find it on his page.
No, but I did want to ask you a question about Gordon and his his forecast coming true. Doesn't matter, sir, if he's accurate, if it doesn't reflect in the stock price, though. I mean, isn't that the whole purpose here?
Yeah, I mean, in the near term, stocks can go up and down pretty wildly despite fundamentals. So that's what happened to 2021. Clearly, looking back on it. Did you, Kristen, how are you?
Hey, Aman, how are you?
I'm good. Do you have the accounting thread?
I don't have it right now. Yeah, I don't know. I have it on the other sites, but not on Twitter. I just want to share something that you guys will be, I think it will be interesting for you to know.
Mm-hmm.
Yesterday was the most awkward all hands meeting Tesla ever had in her existence. The most awkward of all.
Mm. All right, I found the thread. So let's focus on this for a second. So this is at the top of our screens. This is a Gordon Johnson thread from October 2024. That's why I couldn't find it. Man. I thought this was more timely. Where it says currently building a plant with a value of 75% of its all existing land equipment when separately itemized AI infrastructure spend was $3.7 billion. 2.2 of which was spent in Q3 alone. Yeah. I mean, these are the GPUs, obviously. Okay. 3, why says retiring assets that have been depreciated by just 14% without any impairments / asset sales when the industry average retiring assets 56% depreciation with impairments on asset sales. Hmm. Interesting. Okay. Why does Tesla purchase billions of dollars in PP&E? Yes, Steven, you can't post anything up top without checking in with me.
Sorry, I was trying to send it to the chat.
Why does Tesla purchase billion? Grok is horrible. Like I don't know why people ask Grok their questions, because I've seen so many mistakes. So many. It's like, for example, I posted last night after Elon's presentation on the all hands meeting. In 2018, he said, "Don't buy our stock. If you don't like volatility, please don't buy our stock." And then last night he goes, "Hold on to your stock." And I was like, "Wow, that's 2018 Elon versus 2025 Elon." And somebody asked Grok, "Did Elon really say that?" And Grok says, "No, I can't find anything that Elon said that." That's because the fucking presentation happened literally minutes ago. It's not, like, obviously Grok doesn't look at the videos yet. So, and yet people kind of go by what Grok says. It's by far the worst among many of the top LLMs. Why does
put
Tesla
Fred's
purchase
article in
billions
the
of
chat.
dollars in? Okay. Why does Tesla purchase billions of dollars in PP&E every quarter, even when it's not building new car plants? And why is Tesla currently spending more than 2x on PP&E with no car plant currently constructed? And that it was, I mean, they have equipment going into Texas, and they have the AI, the GPUs they're buying. So when Tesla CFO said on the Q2 2024 earnings call, Tesla's expenses in Q3 would be up. Did Tesla expenses show a Herculean fall in Q3, and its profit EBIT per unit sold go from $5,800 to $47 per car? Is Tesla capitalizing a lot of OPEX? He says, admittedly, which is exactly what I said actually yesterday. Admittedly, without seeing Tesla's general ledger, it's impossible to answer these questions, but we have a very hard time bridging the gap. We're open to any expect. I mean, that's, yeah. PwC gets the detail, so it's hard to question, second guess without proof. The Tesla Q bears have always had issues with Tesla accounting, and I've always said it's very, very unlikely there's some material misstatements in Tesla accounting statements, financial statements, and that remains to be the case today. I don't think there's any accounting irregularities. It's just an overpriced, extremely overpriced stock. Stephen?
So who actually conducted the audit? It wasn't done by Tesla, right? It's some third party who was just analyzing public data. Is that what they found, or do you know any more about it yet?
Who audits Tesla's financials? It's PwC, PricewaterhouseCoopers.
I'm saying who identified the 1.5 billion gap?
Oh, it's just Financial Times journalists. I wouldn't worry about that. I don't know why that one got so much attention. I don't think it's a big deal. It can be multiple reasons, and we don't have the data to determine what it is. And PwC does. So, but this has been going on for about 50 minutes. I don't want to really stay too much here. Let me see if I can take a second look at it. Financial Times casually mentions $1.5 billion has gone missing at Tesla. $1.4 billion allowed to fall through the cracks. Man, it's so crazy. Everybody's sharing this article without understanding what it actually is. Kristen?
I just want to give you one example, Yaman. Do you remember a few years ago when was an article saying that Musk spent Tesla's money on his own house? And everybody said, no, 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 that can be
Yeah,
possible.
I don't want to really. I mean, those are immaterial amounts. I am focused on anything more than $1 billion. So I want to just focus on this, if you would please let me do that.
Yeah.
Thank you. So $1.4 billion. Man, this article has been shared tremendous amount. That's crazy. We read the finance Tesla article yesterday, so let's look at this electric article on it. I wonder if he added anything to it. Tesla accounting practices are raising red flags as a new report from finance Times shows that $1.4 billion are missing. Many Tesla shorts and detractors have questioned Tesla accounting for years, but they have never gained much traction until now. Today, Financial Times has released a new report pointing to a $1.4 billion gap in assets compared to Tesla's capex in the last 6 months of 2024 to its valuation of the assets that money was spent on, and $1.4 billion appears to have gone astray. The article points out that Tesla reports having spent $6.3 billion on personal property and equipment, excluding finance, leases, net of sales, in the second half, while the property equipment rose by only $4.9 billion in that period. Ekti, did you have something to say?
Yeah, remember I told you last week, like I asked last week, like how big of a difference is it reporting a fake car and on stage and doing some mumbo jumbo with your accounting? And if I was looking into the accounting, I would look into ZV credits and other credits, and maybe they pumped up those numbers. I mean, there has to be a way to find out, and that way, because that's how they make a profit. They sell those things in Q4 and deliver, profit year on year. So I don't know if anybody has looked into that.
Okay. Yeah, again, I want to just focus on $1.5 billion. Thank you. Okay. Accounting experts agree that in most cases, the capex numbers matches closer to the increase in gross PP&E, but some factors can make a difference: sales or impairment assets, foreign exchange, etc. However, Tesla didn't report any significant enough change in the usual suspects to justify the difference. The report also points to other red flags, like Tesla claiming to sit on $37 billion of cash and raised $6 million in new debt last year. While it's not unusual for companies to cash to raise debt, it's less than ideal in this current environment. Finally, FT reports also points to Tesla not offering to share buyback or dividend despite claiming $15 operating cash flow last year. In 2022, Elon said they would do a share buyback, but it never happened. Jacek Welch, professor of corporate finance at SRH, Berlin University of Applied Sciences, compares these red flags to recent financial scans like Wirecard, blah, blah. I have some experience in financial accounting, says Fred. Okay. I even learned the basics from the excellent Brian Bruschi and Wharton, but I never felt that I was knowledgeable enough to make such an accusation against Tesla. KD accounting and Tesla is something people have been pointing out for years, but it's the first time I've seen getting traction, blah, blah, blah. This is likely going to put pressure on Tesla's auditors. However, for those hoping Tesla to get in the hot water for cooking the books, I would remain careful. Not only could there be explanation for this, but this Trump and Musk kneecapping the SEC. I'm like, joke on that article. Let's just pull Tesla's 10K. Cost of automotive sales revenue includes direct and indirect materials, labor costs, manufacturing overhead, including depreciation costs for tools, machinery, shipping, and logistics costs. Okay. Cost of the leasing revenue includes depreciation of leasing vehicles. All right. Energy generation and storage. Cost of energy generation and storage revenue includes direct and indirect material and labor costs. Manufacturing overhead include depreciated costs, total machinery, freight, etc. Let me just grab a paper here. Okay, so depreciation. This is from cash flow in the 10K. Depreciation, amortization, and impairment. $5.4 billion in 2024. In 2023 is 4.7 billion. And in 2022, it's 3.7 billion. So just in a first look, 3.7, 4.7, 5.4, that looks pretty reasonable, like increase wise. They've been obviously investing in assets quite a bit as they grow, and especially in 2024, they bought billions of dollars of AI infrastructure. So that looks fine so far. First look at DNA. Give me 1 second. One more thing I'm going to look at on the cash flow. I'm going to pull the numbers for purchase of property equipment, excluding the finance leases, net of sales. Let's grab that. CapEx. Okay. So for 2024, it's 11.3 billion. For 2023, it's 8.9 billion. And then for 2022, it's 7.2 billion. Obviously, a massive increase in 2024 due to GPU purchases. Before that, you can see that CapEx is basically twice as much as depreciation per year. And then in 2024, it rises above twice as much. And that's because of GPUs haven't been depreciated yet. Or they haven't fully been depreciated. So there's an acceleration. And think about something more. 10.8, 9.4, 7.4. I mean, I like just looking at these numbers, I don't see a huge difference here, CapEx is growing. CapEx is twice the amount of depreciation, amortization, impairment in general speaking. So we can look at Q1 or whatever, but I don't think that's gonna be that's good. Yeah, I think it's the same. Okay, let's continue with depreciation real quick. Vehicles that are at least part of a blah, 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 because less accumulated depreciation. We generally depreciate their cost, less residual value using straight line method of cost of accounting. Automotive list of revenue over the contraction period. Gross cost of open lease vehicles 2024, 2020 was 7.03 to 7.36 billion. Okay. Accumulated depreciation basically the same. Okay. Solar energy systems. Gross cost of such systems was 6.789, 6.87, same. Depreciation 1.86, 1.64. That's fine. Yeah, there's one thing that's a little weird here is the maybe I'll do an article on this later. I'll keep this for now. There's one red flag on Tesla's depreciation that people haven't talked about yet. But we can talk about it later. We're gonna get back to that. Okay. All right. So in 2023, as of December 31, 2023, we have $29.7 billion of net PP&E. And in 2024, we have $35.8 billion. Versus $6.1 billion difference increase in total PP&E. And then that's net. And then you have the gross 41.7. Remember 8 and 51.4. And accumulated depreciation is 12.06 and 15.6. Ties. So they're saying this increased 9.7 billion. I don't even know what the article is claiming, to be honest. It's kind of unclear a little bit. But 10.4, 9.6 billion increase. And capex increase 11.7. Is that the difference? 1.7? Below zero capex missing. Above zero asset value rises more than capex. Below zero capex missing. Capex more than asset value rising. At 2.2 billion. 1.7. I don't know where they're getting 2.169. I have no idea. Compared to his capital in the last 6 months of 2024 to his valuation of the assets, that money was spent on 1.4 billion per settlement. That's right. Let me see 1 second. Other points that Tesla report 7 spent 6.3 billion at purchase of property equipment in the second half of 2024. Well, we have 11.3 in full 2024. Our property equipment rose by only 4.9 billion at that period. All right, let me pull up the Q2 statements. The balance sheet. $32.9. 4.9, equipment rose 4.9, 32.9. So that can't be either. Okay, so let's go to the 10Q. $46.5. 46.5. Okay, so they're saying the gross amount in June 30, 2024, gross EP&E, June 30, 2024, was 46.55. And then in December, it went to 51.4. And they're saying this is 4.9 billion increase. Gross profit increased. Okay. And it's about 6.3 billion PP&E excluding finance lease in the second half of 2024. So we're gonna keep this open, and now we have this here too. Okay. So we have the machinery, equipment, vehicles, furniture increasing from 16.3 in December 31, 2023 to 17.3 in June 30, 2024 to 18.3. So that's in line, 1 billion, 1 billion, 1 billion every 6 months. Land and buildings. Land and buildings went up from, give me 1 second. Okay. 9.5 to 10.3 in 6 months, and then 10.7. 9.5 to 10.3, 10.7. This is reasonable. And then AI infrastructure. So this doesn't appear. Oh, no, there we go. It went from 1.5 to 2.5 to then 5.2. 1.5 to 2.5. So that's 1 billion in the first 6 months of 2024. And then a large purchase in the second half of 20. I mean, we know Tesla's doing this. Like, that's fine. So that's a big increase. Okay. Tooling 3.1 to 3.6 to 3.8. That seems reasonable. Leasehold improvements 3.1 to 3.4, and then 3.7. That's fine. Computer equipment hardware and software 2.4 to 2.6, 2.9. That's okay. And then construction progress 5.8 to 6.8 and 6.8. Okay. I mean, that seems okay. And accumulated depreciation 12.1 to 13.6 to 15.6. Fine. Um, Depreciation expense during the 3 and 6 months ended June 30 was 981 million, 1.91 billion. That's okay. Depreciation expense during the 3 and 6 months periods ended June 20, 800 million, 1.5. That's fine too. Construction progress primarily comprises of ongoing construction and expansion of other facilities, equipment, tooling related to manufacturing products, as well as air-related assets. Okay. Construction progress promotes construction facility, equipment, tooling related to manufacturing of assets have not been completed assets are transferred to their respective asset classes, and depreciation begins when an asset is ready for its intended use. I think that's fine. Looks like they added that sentence in there, but that seems reasonable. Depreciation during the years were 4.1, 3.3, 2.24. Oh, so okay. Okay. So note 7 on the 10K says depreciation expense during the year ended December 31, 2024 was 4.12 billion. And then you look at value amortization. Hold on a second. Depreciation, amortization, and impairment was 5.4 billion. Net carrying value of our intangible assets decreased from 178 million to 150 million, mainly from amortization. Because that's very little. So there's a big impairment. Amortization of leased assets. Finance lease expense. 493 506 409. Depreciation amortization 2.7 billion. Deferred tax liabilities. Depreciation amortization, including cost of revenues for the automotive segment, was 3.68 billion. Reasonable. Including cost of revenues for energy was 377 million. So that adds up to hold on, just jot that down. DNA in store revenues. For auto 2024 was 3.68 billion. And then energy for 2024 was 377 million. So if you add those up, we're looking at 4.05 or 06 billion. Okay, so if I go back, um, so note 7, it says depreciation during the years ended December 31, 4.12. So that adds up. So the difference is going to be impairment. So there's a $1.3 billion impairment. $1.3 billion impairment. Okay. We account for all digital assets as crypto assets, as such that indefinitely lived intangible asset in accordance with ASC 350/16 intangible crypto assets. We have ownership of and control over our digital assets, and we may use third-party custodial services to secure it. The digital assets are initially recorded at cost and are subsequently remeasured on the consolidated balance sheet at fair value. Periods prior to January 1, 2024 include digital assets at cost net of impairment losses incurred since their acquisition. Give me 1 second. For periods prior to January 1, 2024. Review our property, plant, equipment, solar energy systems, long-term preparedness, and intangible asset impairment whenever events or changes in circumstance indicate that the carrying amount of an asset may not be recoverable. We measure recoverability by comparing the carrying amount of future undiscounted cash flows that the asset is expected to generate. If the asset is not recoverable, its carrying amount would be adjusted down to its fair value. For the years December 31, 2024, 2023, and 2022, we have recognized no material impairments of our long-lived assets. I mean, they say there's no impairment. Okay. No material impairments in 2024, 2023, or 2022. Long-lived assets. And on goodwill, no impairment on goodwill either. I mean, that would be in goodwill line anyway. So, well, this is a head scratcher. So funny. Capitalization software costs. No impairment in 2024 for capitalization software costs either. Digital assets. During the years ended December 31, 2023 and 2022, we recorded immaterial amount of and $204 million impairment loss of digital assets, respectively. A table below shows summarized showing the consolidated balance sheet. So no impairment in 2024 for digital assets. There were no impairment losses recorded for any period during the year ended December 31, 2024. As a result, the unaudited interim balance of digital assets net did not change throughout the year. Goodwill decreased $9 million within the automotive segment from 253 as of December 31 to 244 million as of December 31. There were no accumulated impairment losses. Okay. Yeah. In June 2024, Elon Musk redirected $12,000 NVIDIA H100 graphic processing units originally allocated to Tesla to his company's XNXAI. This shipment was valued at approximately $500 million. Musk explained that Tesla lacked the immediate infrastructure to utilize the GPUs, stating they would have just set in a warehouse until the expansion of Tesla's Gigafactory in Texas was completed. Consequently, GPUs were diverted to support AI development in XAI. I mean, I guess that could be one piece of it here. I don't know how they would account for that, but I don't know. That's scratcher for sure. Maybe they I mean, business combinations net of cash acquired. 0.140. Share was impairment 2.5 billion. Was an impairment 5.4 billion. 2.5. E3. 3.9. Okay, so 2.2 in the first 6 months of 2023, 2.5 in the first 6 months of 2024, and then 1.4 billion in Q3, increasing, and 5.3, 3.9, 5.3, it's 1.4 again. That's really weird. I mean, I don't see a big jump in depreciation, amortization, impairment. It's basically in line with what I would expect. They say there's no impairment in long-lived assets. No reason not to believe that. CapEx increase as we would expect. I mean, the only other thing that can be is there. Um, ah, credit, cash, debit, assets. That would go into CapEx. Um, cash, debit, asset. Maybe the asset size on another line. That's the only thing that can be really. Something they classified as CapEx with a debit on another account outside of PP&E on the asset side. That's the only thing that can be. Let's see. Cash and cash equivalents, short-term investments, AR. Fine. Inventory 12 billion. Prepaid expenses and other current assets. A $2 billion jump there. So we can look at inventory and the prepaid expenses after that. Operating lease vehicles went down from 6 to 5.6. Maybe they reclassify something from PP&E to, but then the depreciation would drop. No. Yeah, maybe they reclassify some PP&E to operating lease right of use. But they would have to note that. Reclassify. There's a big jump in prepaid expense, other current assets. We can look into that. There's a drop in inventory. That's because of vehicles. Reclass. Certain prior period balances have been reclassified to conform to the current period presentation in the consolidated finances accompanying notes. But what have you reclassified? Certain period balances have reclassified to conform to current period presentation. Doesn't say what. Okay. It's the only reference. Inventory. Inventory and purchase coming write-downs. Looks okay. Raw materials stable. Work in process down 500 million. Finished goods down 1.1 billion. Not one. Finished goods includes products in transit to fulfill customers' need because we knew that already. We write down inventory for any excess or obsolete inventory when we believe that there's net realizable value inventory is less than the carrying value. During the years in 2024, we recorded write-downs of 190 million, 233 million, and 144 million respectively. Okay. The service parts looks fine. But there's just drop is because of finished goods, and we know the inventory. There was an inventory drawdown. We know that. Let's look at prepaid. VIEs. 3.3 to 5.3. We have customers who still under legacy My Power loans, which provide the residential customers the option to finance purchase of the solar energy system through a 30-year loan, and we were originated prior to 2018. Outstanding balance in the NLS executed are presented on the consolidated balance sheet as component prepaid expenses and other current assets for the current portion, and as other non-current assets for long-term portion. As of December 30, 2023, total outstanding balance of My Power customers for NLS credit was 248 million, 206 million respectively, which 4 or 5 were due to the next 12 months. That's not it. The portion of warranty reserve expected to incur within the next 12 months is included within accrued liabilities and other, while the remaining balance is included in other long-term liabilities. For liabilities that we are entitled to receive indemnification for our suppliers, we record receivables for the contractually obligated amounts on the consolidated balance sheet as a component of prepaid expenses. Let's see. A portion of the warranty reserve for liabilities that we're entitled to receive indemnification from suppliers. We record, 1 second. We record receivables for contractual obligated amounts on the consolidated balance sheet as a component of prepaid expense and other current assets for the current portion, other non-current assets. Warranty expense is recorded as a component of cost of revenues. Due to magnitude of autonomous business, accrued warranty balance primarily related to autonomous segment. Accrued warranty activities considered following. I don't think that's that. 8.3 to 5.2. Okay, let me just look at one more thing here. If capex, okay. On the balance sheet, where would company look? Okay. Capex was already reported expense of income statement. Instead, they appear on the balance sheet as an increase in assets. Specific capital required property and plant on the asset side of the balance sheet, increase the gross PPA amount over time as it's depreciated. Blah, blah, blah. Okay. Booked as an increase in PP&E under non-current long-term assets. Then, okay. Is that the only place? Is it the only place? Accompanying with book. Capex. Great fellow. While PP&E balance is the main place, whereas the capex actually touches a few other places in financial history. Here's a full picture. Yes, capex and PP under non-current assets. It may also affect construction in progress. the IP if the asset isn't ready for use, but that's in there already. CapEx shows up on investment activities as a cash outflow. Income statement indirectly. Okay, we done that. Most of finance things. The balance sheet PPN is where it goes booked, but it's cash and paying and cash is same problem. Is PPN assets accounts where CapEx would show up as an increase on the balance sheet. While PPN is the primary and most common account where CapEx shows up, CapEx can increase other asset accounts on the balance sheet in certain cases. PP&E, things like building and machinery, vehicles, etc. Construction in progress. But construction, in Tesla's case, construction progress is part of PP&E. Intangible assets. If CapEx is spent on software development, patents, or license, it might increase intangible assets rather than PP&E. Internal use software developed in-house after feasibility established is capitalized as an intangible asset. Okay, we'll take a look at that. Leased assets, ROU assets under ASC 842, IFRS 16. If a company enters into capital finance lease, the lease asset is capitalized as a right of use asset, which is a non-current asset. While technically not purchased, this is considered CapEx in economic terms. If a company enters into capital finance lease, the lease asset is capitalized as a right of use asset, which is a non-current asset. Okay. Capitalized asset improvements, upgrades. Spending to extend the useful life or increase capacity of an existing asset can be capitalized, even if it's applied to assets not initially classified under PP&E. And that could be it too. There's number 3 of them. Intangible assets capitalization. The internal software developed in-house capitalizes an intangible asset, or spending to extend the useful life or increase capacity of an existing asset can be capitalized, even if it's applied to asset not initially classified as under PP&E. CapEx will not appear in current assets like inventory, prepaid expenses, accounts receivable. Those are operating items, not capital investments. Okay. Summary: PP&E is the main place, but construction progress, which is part of PP&E in Tesla's case, so that's not it. Intangibles or ROU assets can also be increased due to CapEx, depending on the nature of the expenditure. Okay. Okay. So let's take another look at the balance sheet here. Operating lease vehicles went down from 6.0 to 5.6 billion. So that's probably not it. Solar energy systems went down as well. PP&E we covered. Operating lease right of use assets went up $1 billion. Operating lease right of use assets went up $1 billion. Digital assets went up $900 million. But that wouldn't be in CapEx. Intangible assets are the same. Goodwill is the same. Deferred tax assets declined. Other non-current assets declined. So it's probably operating lease right of use assets. Operating lease. Right of use. We own the building and the land use rights with the initial term of 50 years. The land use rights are treated as operating lease right of use assets. This is for Gigafactory Shanghai, Megafactory Shanghai. That's what it is. Fucking A. Jesus Christ. Let's go fucking forever. That's what it is. It's fucking mega factory Shanghai. That's what it is. God, took forever to figure that out. Jesus. Ugh, fucking morons. Can't believe I wasted my time on this fucking stupid Financial Times article. Idiots, they're like, PwC, can't figure it out. Fuck you. Who the fuck do you think you are? Let's tweet this out. Financial Times. That. I mean, I'm pretty sure this, but what the fuck is? Right of use assets. All right, let's see. Shoot again. Upland Sons, fucking idiots. God, these people are just fucking morons. Gosh. There we go. I'll post this up here, and you guys can repost it if you so wish. But I think this is my opinion. It's probably Gigafactory Shanghai or Mega Factory Shanghai. All right. That was a waste of fucking 45 minutes. Thank you very much, everybody. and I will chat with you all next time. Take care.